Yeah, let's take a look at chapter 14 here. Just kind of run through it. I'm going to try to run through it quickly. Might help you with the quiz, might help you with your assignment a little bit. Maybe understanding these capital markets a little bit might help you in life a little bit. There's been interest by those in class regarding investing in those types of things, and knowing the background of these things then becomes really important. So here's some questions that I've asked in the past, and we'll actually answer these as we go through. But what are the acronyms for the two major U.S. stock exchanges? What government agency regulates the securities industry? You guys should know that from business law. Short-term markets comprised of securities with maturities of 1 year or less. I'm not sure if we answer that one or not, but those are money markets. What's the common name for the Chinese currency? We don't answer that one, but the common name is the yuan. Y-U-A-N is how we spell it anyhow. Renminbi, I believe, is the true name. The rate paid on the last dollar of income is called, and I don't think we talk about that here, but we've talked about that before. That's the marginal, right? Long-term markets consisting of securities having maturities greater than 1 year would be, we generally call those, I might have to wait until I get into that one. I'd call those capital markets myself. A primary advantage of investing in municipal bonds is tax savings. This was a while back, but Square and one today that announced it's going to do this. Snapchat just announced that it's going to go public, okay, meaning it will create an opportunity for you and I to purchase stock in that company. That's called an IPO, or an initial public offering. Least used of all long-term securities, since the dividend is not tax deductible to the corporation. That would be a preferred offering. Security trades in appropriate markets, not the original offering. Provides, so both of these together basically are the same answer, which is the secondary market. That's the one we're most familiar with. When a company purchases its own stock because of an availability of surplus cash, and this is one that may affect a decent number of the companies that you guys are reporting on, and that's called, it creates treasury stock, right? When a company purchases its own stock, it creates treasury stock, or stock buyback too, we kind of do. So government spending, I guess, there, huh? That was 2011, though. Remember, we were coming out of the recession in 2011, and so we had this huge deficit, which has gone down some since then. So just some stuff that we're going to talk about. So types of security markets, right? They consist of various government bonds, corporate preferred, corporate common stocks, so all kinds of different things, right? They are influenced by interest rates, certainly, investor confidence, certainly, economic growth, and global crises. One of the things, and when we talk especially about corporate preferred, but maybe really in particular about corporate common stock, and it's not listed down here, is earnings. They should be affected by earnings. That should be really the main effect on the corporate common stocks and the prices and whatnot, is their earnings and potential future earnings, right? Rates, confidence, sure, all those things, they have more short-term impact on corporate common stock, but ongoing earnings is key. If you got a company that's going to make a lot of money over the next 20 years, you could throw all this stuff in the garbage can, right? Okay, if they're going to make a lot of money, that would be a Warren Buffett philosophy too, a little bit. So money markets, right, are those short-term markets, securities with maturities of less than 1 year, and these are some things that we throw in there, right? Treasury bills, they're called. That's the government's financing on a short-term basis, commercial paper, and negotiable certificates of deposit. So capital markets, they're the long-term markets, right? Okay, bonds, common stock, preferred, these types of things. Now, these trade, okay, even though we call these capital markets and long-term markets, these trade on a very regular basis. You could buy a common stock, right, this morning and sell it this afternoon. You could buy a long-term bond this morning and sell it this afternoon, right? Any of these, okay, but they are long-term financing for the company that issued them, Okay, so it might be short term or very liquid for us as investors, but they're long term for the companies that issued them. International, this is becoming a much bigger deal, right? Okay, so we got more nations that are adopting basic principles of capitalism. There's global privatization, meaning that companies are becoming private or turned loose, or even in China, which we've called a communist nation. You guys aren't old enough to remember, but we hadn't had a president even visit China for a long time. Their borders were basically closed till Richard Nixon did in 1972, and even then it was a decade or more before we started trading, probably a couple decades before we really started trading significantly with China. It's only been in the last maybe couple decades, okay, that China has become a major economic force and one that we deal with. Okay, so in your guys' lifetime, basically, those things have happened, right? And that's opened up a lot of markets. China's now a huge investor in U.S. markets, and kind of vice versa too. Reduced telecommunication costs, the internet, yeah, on and on. International free trade, boy, did that get some conversation going then, and you can look at some of those in this last election, right? Kind of got a repeat here. NAFTA may be going by the wayside, and I got to tell you, I'm a free trader. I believe in free trade, even unilateral free trade, which might be in, I guess, an opposite view of what our president-elect has, Ross Perot was a major third-party candidate way back, and he was adamant that was his one issue, was about NAFTA, really, that it was horrible. He says you hear that giant sucking sound, that's the jobs leaving the U.S. and certainly you can point to certain jobs that have left the U.S. and gone to those. Has it affected the U.S. economy? Yeah, I don't know. We're still by far the biggest economy. We're still growing better than a lot of other economies around the world. So it's kind of interesting. CAFTA then would be the Central American Free Trade Agreement. And I'm not sure. I think it had some level of approval, but I don't remember if it was actually voted on and passed by the Senate. Sorry, I don't remember that. Just some more humor about those types of things. So equity markets. Okay, equity markets are common stock. When we talk about equities, we're talking about common stocks, right? And that's because you have an equity, right? When you look at the balance sheet, okay, you've got assets, you've got liabilities, and owner's equity, right? Equity markets consist of that part of the balance sheet. That's the equity market. So when you buy a stock, you have a part of that equity in that company, right? And it shows you how big, how huge the U.S. markets. We have two exchanges here that are by far, either one of them, by far bigger than the other exchanges. Okay, again, it really points to the viability, I guess, and the dynamism of the U.S. economy and our equity markets and our capital markets, for that matter. So, international, right? Companies can raise debt, capital at the lowest cost because they can offer it all over the world, right? And I was going to say something, but I kind of lost my train of thought. Many want to list their common stock around the world, right? It increases liquidity, and so it might be listed with the New York Stock Exchange and the NASDAQ, but it might be available, right? Just like you and I, if you go back, we can buy stock in, here's the Euronext, right? We can buy stocks. Adidas, for example, is listed on the Euronext, and yes, the NYSE and the Euronext are combined. It's actually the New York Stock Exchange, actually owned by the European. That's kind of odd, isn't it? But we can actually purchase Adidas stocks kind of on the U.S. Stock Exchange, even though it's a publicly traded stock in Germany. Okay, and so opening up these markets have added a lot of opportunities for us to invest in whatnot, right? Where 50, 60 years ago, it would have been extremely difficult to do that. About 3.8% of foreign investment has been invested in government securities. I think that's foreign investment in the U.S., probably in government securities. So So competition for funds is what this is talking about. I think that might have been part of your homework assignment, right? So in the U.S. capital markets, the federal government competes, right? Very much competes against private enterprise because the federal government borrows 400 and I don't know, it's close to $500 billion a year, okay, which is insane. Compared to if you remember at the end of the 1990s, we actually had a surplus for about 2 years, and we've just gone haywire, and now there's all kinds of debt available. I guess you and I could buy it if we wanted to or invest in it. Government agencies would consist of things like Fannie Mae, Freddie Mac, Sallie Mae, Ginnie Mae, those types of things, okay, that also borrow money. So the federal government, the $19 trillion in debt that you see, doesn't include some of those other things. We might talk about those a little bit. State governments can, and local municipalities can, certainly, right? And so, yeah, if you're an investor, you choose amongst those. And your risk return, is kind of based on corporate versus non-corporate, or corporate versus government types of securities, right? So U.S. government securities include Treasury. Okay, that's what the government uses to borrow. That's the main thing. That's the $19 trillion that we see, right? They can sell short or long-term securities. Hopefully, in this era of extremely low rates, they are selling, okay, all kinds of long-term securities and financing our huge debt over the long term at rates that are, kind of unheard of. I doubt that they're that smart. They're probably still selling a lot of short-term. Federally sponsored credit agencies, and here's some of the ones that I was talking about, right? The federal home loan banks, but if you go over here, the Fannie Mae, Freddie Mac is just like Fannie Mae. These are agencies. Fannie Mae and Freddie Mac were huge players in the financial crisis, and listening to a senator talk about them today too. It's really an oddball situation because while they are private companies, more or less, the private investors can own, okay, or public, I guess I should say, public in the fact that you and I could own it, but privately held, meaning that the government doesn't technically own them. The government technically backs them, okay, and so they don't have the same requirements that banks and those types of things have. And what they do, okay, what Fannie Mae and Freddie Mac do, though, is with the backing of the government, they can obviously issue debt or sell debt, right, at very low rates. 10-year debt is about 2% right now, let's say, and then they can turn around and they purchase mortgage loans, okay, that might be yielding 3 or 3.5%, okay, and so basically they're using the backstop of the government to get lower rates, and then using that to allow them to finance homes and whatnot. The purpose is a good purpose, don't get me wrong, but it's kind of an interesting setup. It's a little different than I guess the normal private markets that we might normally think would handle those types of things. Farm credit banks, Student Loan Marketing Association, Sallie Mae, there's $1 trillion student loan debt out there, operates much like this, right? So Sallie Mae can borrow money, cheap, finance student loans. State and local securities, right? Municipal securities are tax exempt, so from federal taxes. So small, or not small, small, large, medium, whatever size communities, counties can issue debt, okay, and it's tax exempt if you or I invest in it. Okay, and so you'll see a lot of retirees, especially, they like that fact that they can put a lot of money into municipal bonds, okay, they're called, and receive, going rate today might be 2, 3, 4%, but it's tax free. So it's a huge deal. You'd have to earn an extra couple percent probably to make up for the tax free part of that. This is for people obviously that are in a little higher income. Okay, right there, higher marginal tax brackets. Okay. They're generally supported by revenue generating projects. So usually municipal securities are revenue generating, though, like it might even be like garbage collection. Okay, so maybe the city of Havre needs to issue some bonds, to purchase some new garbage trucks, garbage containers, and those types of things. But they can raise the fee that they charge the city residents, right, to collect the garbage and whatnot. Corporate bonds are debt instruments. You guys should all look into the bonds, okay, of your companies. Absolutely look into the bonds of your companies. Okay, they have a fixed life and to be repaid at maturity. Some of them have call features, which makes the fixed life potentially shorter. Means that a company can pay off that debt ahead of time, okay, without penalty. Okay, and that's call feature, it's called. Okay, generally corporations finance old debt with or refinance old debt with new debt. Generally, not always. You know, companies reduce debt too. They have been for the last several years, actually. Preferred stock's the least used. It's kind of a hybrid, right, of common stock and bonds. What I'd tell you is it's kind of a hybrid that has all the disadvantages of both and not necessarily the advantages. Okay, that's from the corporation standpoint. It has those disadvantages. From an investor standpoint, it has lots of advantages, and that's why people like to have preferred stock. Okay, they like to invest in preferred stock. Not a lot of companies that offer it. Okay, and the reason for that is that as compared to a bond, say, a preferred stock, the dividends that they pay aren't tax deductible for the company. Okay, from an investor standpoint, you don't actually have an equity interest. You kind of do, kind of don't in the corporation, but you'd get paid off first in a liquidation. So there's just a lot of interesting things in preferred stock, and we don't need to spend a lot of time. Again, not many companies. You might look to see if your company though has that, right? Common stock. That's generally speaking what your paper's about, right? You're kind of reviewing the common stock and whether or not a person ought to be buying that, right? Either sold as a new issue, there's a public offering, or as a secondary offering. And the secondary market, okay, is for stocks that are traded between individuals, but companies can come in and do secondary offerings themselves, right? Meaning that they can issue more stock at a given point in time. They might do that, right, if they're maybe a major purchase or something. Maybe they're buying another company and they need to issue new stock in order to do that, and those types of things happen. Treasury stocks, when a company purchases its own stock, okay, and they do that because they have an availability of cash. We've seen a lot of that in the last 5 or 6 years. Companies have found, with our slow-growing economy, they've found fewer places to invest their cash, in growing ideas, in research and development, buying other companies, whatever the case may be. They're finding those to be a little bit scarce, and so what they do instead with their cash is buy back their own stock, right? Which increases, it should increase both their ROE and their earnings per share, which are things that are valuable to the investors, and gives money back to some investors, right, that want to sell their stock. So internally generated funds include retained earnings and cash flow added back from depreciation, right? So those are internal. And again, we get a lot of companies generating a lot of cash right now. Okay? It's a function of corporate profitability, the choice of whether to pay dividends or not. If you don't pay dividends, which you keep, is called retained earnings, right? The depreciation tax shield, okay, there's talk about this going on right now, with the recent election, and that is that in some cases they want to eliminate depreciation. Now, by that I don't mean that they're going to eliminate the tax deductibility. Contraire, what they would be doing is allowing direct expensing of those types of purchases. So right now, if you're a company and you buy a $1 million piece of machinery, okay, that's going to last 10 years, well, this is an oversimplification, but you might depreciate that. In other words, you don't get to write the $1 million off on your taxes. Okay, you depreciate it over 10 years then, so you write off $100,000 per year from your taxes. Okay, one of the proposals now might be to move all that up so you could expense that in the very first year. One of the reasons that that Congress likes to mess with that, and the president and those folks, is when you do that, you encourage companies to get out and buy more equipment and whatnot, which can be a stimulative to the economy, right? Internally generated funds, so you got retained earnings, probably the biggest source of that, and depreciation, and what that does then in terms of how it affects the cash flow. Remember some of the cash flow problems that we did earlier, and the effect that depreciation has on that. The household sector. So what's the supply of capital funds? Well, it's you and I. right? It's our savings accounts, and I know a lot of you think I don't have any savings, okay? But believe it or not, even so, like there's a fairly consistent, like even the folks that don't really save anything, they get paid, their paycheck goes into the bank, it's there for a few days, and the money goes out and this and that. It's fairly consistent level then that banks, because they are they're primary depository for paychecks and those types of things, and there's a fairly consistent level of that money that banks can count on. Okay, builds up over time. If they've got 10,000 customers, it kind of averages out, and it ends up being a significant amount of money that the banks can count on, that they can invest. And in addition to that, there are people that have savings, right? CDs, whatever, at banks, okay? Transfer payments from the government, same thing as wages, so you get Social Security, right? And it goes into the bank, and same thing. It's a decent amount of consistent deposits that banks can count on. Wages and dividends from the corporations. And then, you've also got, if you go spend your money and you spend it at IGA, guess what? They deposit it the same day, so it doesn't even disappear then from the bank's accounts. Okay, and so again, if you knew how much got transacted and moved around from day to day at the banks, it can be huge. Okay, but over time it becomes a fairly consistent amount that banks can invest. Just the flow, I don't know that there's anything in here of any huge importance. This I find interesting, right? That the suppliers of funds to the credit markets. So mutual funds and ETFs, and we don't get a chance to talk a lot about them. Great initial places for you guys to invest. Okay, if you get into a 401k or something like that with your employer, this is where your money's likely going to go. Okay, 90% probably goes into different mutual funds or ETFs. Okay, so this has become a huge area of investment. What it allows for is you to be diverse. Without having to buy 100 different companies, right? You instead invest in a mutual fund, and you automatically can get some diversification because of that, right? Insurance companies, remember how insurance works. We all pay premiums, and they don't pay until we get in a car wreck or a house, and so they've got a fairly consistent supply of money on their books, right, that they keep invested. Commercial banks, savings banks, and credit unions, the money that you and I get, wages, savings, et cetera, et cetera. And then the mortgage pools. This is Freddie Mac and Fannie Mae. Huge. Look at that, 11% of supplied money to the credit markets. That's just huge. And then foreign suppliers. Look at that, 25% of our capital, right, or credit markets. I'm sorry, this wouldn't be total capital, but credit markets, so bonds and those types of things. Foreign suppliers, foreign nations, or foreign entities are purchasing. So again, we get down to secondary trading, right? Security trades, and this is what we're doing. It's not the original offering, so it provides liquidity, right? And keeps the prices competitive. So you and I can buy, sell, trade. We could buy or sell, buy and sell the same stock 10 times in a day or 20 times in a day, and literally there are people and companies that do that. They just take advantage of little short-term swings in deals, and they've got computer programs set up to do that. You could argue that hurts the market, but on the other hand, there's always a ready buyer and a seller when you've got companies that are set up to do that, and so it helps to contribute actually to the liquidity. So, in my opinion, it's neither good nor bad actually. So they provide liquidity, right, by enabling corporations to raise funds, issuing some new securities, whether those securities are stocks or bonds, right, equities or bonds, equity or credit, allowing investor to sell them with relative ease and speed. Again, I've called up my broker and said, hey, I want to, sell 10 shares of XYZ, and he'll be plugging it in. I choose a price. I always use limit orders, by the way, and before we get off the phone, which is sometimes less than a minute, boom, I can hear the ding on his computer that the order happened. Okay, I mean it can be that fast, right, and that easy, and you can go online and do that with some companies too, E-Trade, Fidelity, different companies like that. So without the markets, right, corporations and governments wouldn't be able to. And boy, have they changed, right? Technological advances, electronic communications, mergers, alliances, yeah, on and on and on. So I don't need to tell you guys that. Um, yeah, national, regional, I don't know that we need to know a lot about that, right? Central trading locations. It's interesting. Each stock trades at a physical location on the exchange's trading floor. You guys don't remember, if you want to watch a old movie that kind of exemplifies it a little bit. Although this was at either the Mercantile Exchange or the Board of Trade, but Trading Places. It's an old Eddie Murphy movie. And Dan Aykroyd, I believe. It's a funny movie too, but you watch, and this is how they used to trade all the stocks and bonds, commodities, those types of things. Literally had people in the trading pits that were screaming and hollering, using hand signals, on and on and on. Really an amazing system that was actually fairly efficient. Now that's been replaced largely by electronics, right? Regional exchanges, I won't spend a lot of time on that. The Chicago Stock Exchange. So it just means that some companies, some brokerages may go through like the Chicago Exchange versus the New York Stock Exchange, and the stocks are listed probably on both, right? Not something that we need to spend a lot of time, I don't think, worry about. Yeah, exchanges have minimum requirements that must be met before trading occurs in the company. So the New York Stock Exchange, okay, its listing requirements are the most restrictive. So if you want to be in New York, if you want to be listed on the New York Stock Exchange, right, you gotta meet certain criteria. The Nasdaq's a little less restrictive, and the Nasdaq used to be just an afterthought. 30, 40 years ago, it kind of was in existence. It was called an over-the-counter market. But what happened? Well, a couple stocks came along. One in particular was Microsoft, that didn't meet the requirements of the New York Stock Exchange, but it wanted to go public, and it was just an upstart. It was a nothing. Okay, nobody believed in it, and in fact, in the first year or two, it about went broke 4 or 5 times, right? But it stayed in there. And then obviously, for a great period of time, Microsoft was probably grew to be one of the biggest companies in the world. Cisco kind of followed, the computer company kind of followed a similar pattern, and so, the Nasdaq kind of became this place. It's sort of known anyhow as a place for tech startups to get listed there. But as a result, now it's become nearly as big as the New York Stock Exchange, because a lot of those companies have grown to be huge. So, electronic trading systems, right? Alternative trading systems, SEC. I don't know that we need to talk a lot about that. Electronics have become a big deal, obviously. So the New York Stock Exchange merged. Additionally, it ended up merging with Euronext after acquiring Archipelago, which was an electronic exchange. Again, everything's electronic nowadays. The Nasdaq kind of talked about market, as an over-the-counter market. That just meant that brokers and dealers and whatnot dealt with each other, okay, directly, versus having an actual exchange is kind of how it got started. But eventually it grew to becoming more of having a regular exchange and whatnot. So, but it's all trades, have been for quite a while in the Nasdaq electronics. So, just seeing if there's a lot. Yeah, acquired the largest DCN, later Brute. Created more speed, right? Price efficiency, that's kind of cool. Divides its markets into national. Foreign exchanges, yeah, we're seeing more and more. Oftentimes foreign companies are listed on the New York Stock Exchange, so you and I can purchase them. They're called ADRs, or depository receipts, American depository receipts, is that what they're called? And here's some of the other exchanges, no big deal. Futures exchanges have grown. So futures, that creates opportunities for hedges, or you and I can buy futures. If we really want to compound our possible gains or losses, we can buy futures in stocks, okay, commodities, whatever. Futures are a valuable hedge. I used to encourage, in fact, a lot of my customers to possibly use the futures markets to hedge, the sale of their products or commodities, beef, wheat, barley, whatever the case may be, right? But they can also be really dangerous if they're speculative, right? So you can hedge interest rates, commodity prices, all kinds of stuff, right? The CME, or the Chicago Mercantile Exchange, is one of those. I think the CME is where Rod used to work, so. Markets are generally efficient when, right? Prices adjust, and we have that. We've got a fairly efficient market, right? There's a continuous market in which successive trade is made at a price closer to the previous price. Yeah, meaning that there's readily available information, but also readily available buyers and sellers. Okay? And it's efficient when the market can absorb large dollar amounts of securities without destabilizing the prices. Look at the trillions of dollars that get transacted. It's just unbelievable, and our markets seem to be able to handle that pretty well. So fixed income securities, right, have reasonably efficient markets. So, right, the most efficient is that for the U.S. government securities. They're just considered, risk-free basically, and so they trade very easily. Corporate bond markets are reasonable to a degree, and again, probably, corporate bonds for J&J, which are AAA rated, trade probably as efficiently as U.S. government securities. Okay, common stocks, right, been supported through decimalization. Hopefully, I said that right. They used to, they used to trade based on I think it was called ticks, or it was a dollar and a half, or a dollar and a 16th, or a dollar and an eighth, so it was oddball amounts. And then they went to decimalization not that long ago. It seems kind of weird, that we did. I mean, it was almost like our measurement system versus the metric system. So weak form, right? Past price information is unrelated to future price. We don't have a weak form. Semi-strong prices currently reflect all public information. That's probably where we're at, for our common stock and whatnot. And the strong form, all information, both private and public, is immediately reflected in the stock prices. Maybe even somewhere in between those is where we're at. So regulation, right? The SEC, but self-regulation. So the exchanges regulate themselves. The SEC stuff you guys should kind of remember from business law, Securities Act of 33, Exchange Act of 34. Some of these regulations that have been put in place may see some rollback too, right? Mainly it deals with information. The reason we can do a report like this is because we have lots of information at our right at our fingertips, which is kind of nice, and it does make markets more competitive and transparent. 2002 Sarbanes-Oxley, we talked about. I'm gonna pause here for a second. So, just kind of briefly going through these security acts, and again, we had these in law. I don't need to spend a lot of time, but Great Depression, securities regulations, right? 33 dealt with, I believe, new offerings, right? 34 dealt more with the secondary, offerings that we might have, or the secondary trading that happens, right? And talks about registration and those types of things. Okay, and the SEC still got a huge impact. I mean, they've been in the news quite a bit, especially they were with the recession that we had starting in 2007, 2008, and whatnot, because the SEC was kind of responsible for some of those regulations. So Sarbanes-Oxley came along in 2002, right? And it was a result of the Enron fiasco. Most people don't remember that. Some of us old-timers obviously do. But again, it was more regulation dealing with some of the breakdown that we had and some things that we covered in law. So there you have chapter 14.